Hey traders, Rocky here, and to kick off this video, let's jump into the daily time frame trades that we've been looking at, especially the bond and the gold market, where specifically we're looking for what I would call a refire. Now, what does that mean? That means we've had a prior alert. Sometimes it's hit a profit target, sometimes it doesn't, but the actual entry zone remains still a valid entry. So if I were looking at this market with fresh eyes for the first time today, I'd still like, and I would still come to the same conclusion, which is the zone of entry, in this case, the 178.10 level on the ZB contract. And it's going to be the same setup. In other words, if we go back to the first time we did the ZB, it was looking at that June contract to open 178.10 on a limit. Now, this also was simultaneously a trigger for long TLT calls, but now I'd recommend pushing out into July or September, since the June contract is 38 days to expiration, and I'd prefer to have 45 days or greater before expiration. All right, so that's one market. If you're still in it, that's fine. It's still a valid buy. But for those of you that aren't, or for those of you that say, you know what, I wouldn't mind some exposure in long TLT, or in the case of gold, I wouldn't mind some long exposure in GLD or an additional contract. It just is a continuing valid zone to get long. So what's the deal with gold? June gold, I'd still look to buy it, 1688.50 on a limit, and this would be to open. You can purchase again, but I don't want anybody getting too hyper focus on a single market. If you have some exposure here, great. You know, if you have insufficient exposure, or the risk area is one that you can tolerate a position from, terrific. If not, remember that we have two zones, and this applies to any market that is retracing into the wave. You can really easily divide it into two sections, upper and lower. So the lower section is going to be the lower risk. Now, again, I like to really emphasize that this isn't a matter of probability. This is a matter of simply distance to the stop loss. I think the whole zone is a good high probability zone to buy. But clearly, when we have an entry further away from the stop, not that it's low probability, we could follow through to the upside just as well from the top half of the wave, but the risk is different. The distance from your entry to your stop is your risk. Therefore, the upper end of the wave, the distance is further away from the stop, which is placed just below the, as you can see here, 34 EMA on the low. And I'm additionally using the support of this Darvas level. So the further away from the stop you are, the greater your risk. So this is why I say oftentimes you can use options on GLD, you can use options on the GC, you can use the MGC micro contract. Here, you can go with GC, you can go with a larger position with the options, you can go with a larger position with the MGC, the larger position being valid because the distance from the entry to the stop is narrower. The distance from your entry to your stop is your risk. This is where I say it's choose your own adventure. You know what you can risk. You know what position size from each risk level is appropriate for your account. Now, a lot of folks say, well, Rog, what's the percentage? What's this number? In the market money math class, amongst many things I talked about, I really don't want to see a single position really be more than about 5% drawdown, 5% in terms of what I would lose of my account if things go wrong. All right, 5% is about where I'm at. You can be as little as 2.5%. Right? That would be clearly better. And I'll go with something like 2.5% if I'm playing two markets. Let's say I'm playing GLD and GDX. I would do like a 2.5% type breakdown. So the total is 5%, but the theme, the singular idea is that gold moves higher, and then hypothetically I'm talking about, you know, GDX, GLD, or if it was crude, I might be in RB and crude oil, right? So if it's a similar theme, if it's a similar market, similar sector, I'll think about not maxing each one out to 5%, but taking a number of smaller positions with a smaller threshold for a stop. That's another way to look at it. All right, so that is GC. All right, next is taking a look at copper. And I'm also going to talk a little bit about currencies before we break here because I've got my eye on the Canadian dollar futures and the Mexican peso. We'll talk about that as well. So copper went up a little higher than our entry. That's all right. You know, we had a high all the way up to 2.43. Not fun, but we had an entry at 2.3950. We're already coming back down. We're currently trading, as you can see, at 2.38. We're already below our entry, which is great. And what's really nice is copper moved lower on a day that the equity markets moved higher. That to me is terrific, because if the equity markets move lower, I'd like to see copper move even lower still. Staying below the -1 V-score, which is this level, and then that level on the V-score bands is going to be really important. My stop is going to be above that level. I would prefer this market stay below, and then I'd really prefer this market get down to the value area low, which is right there. So for those of you who are asking, okay, Rog, what's our target? I'd like to see this market move to about 28.25. I'm not opposed to taking profit at the point of control. I really wouldn't have a problem with that at all. So, if you're looking for something around 33.20, I've got no problem with that. And if you're looking, maybe that's an optional. And then if you're looking for something around 28.20, again, I have no problem with that. So if you just want to, on your, here, just kind of write optional, looking at the 31.20, and then T1, I would look at the 28.20. And so I'll just put that note right on my, oh, sorry, 33. No, it was 31. So that's the plan. Okay, that's the way I would look at that. And that's going to be 33.20. There we go. So that's a way that we can manage this. Now notice I'm not talking about the market going down to 2.2, although that would be terrific, right? We're going to scale out a little bit more aggressively because the equity markets still are pretty strong, and from time to time copper does gain traction to the upside with stonks. All right, next up is soybeans, which we did get our 855 fill on, so that's great. Now we want some follow through to where we have a nice value area low for the year. So a couple levels that I will look at for targets. We have a nice value area low for the year down here, as you can see, at about 39.4. So I'll look for the 839.5. That's the yearly value area low. And then we have this other level down here, kind of the 830.8. All right, so again, I'm just kind of going by the levels of support, and that would be another target. So both of these are going to be targets. And I think what's really important is that you get really comfortable scaling out of markets. Now, so a common question I get is, Rog, I've only got the one contract. 839.5 is fine. Or once we hit 839.5, put a trailing stop at 840.5, and then see if we can make a run for 830 point, or even 831, is fine. So the idea again is pay yourself while you can, not when you have to. There's a lot of chatter going on right now regarding the ags. Now you might remember around I want to say it was the 17th of April, there was a big announcement about the $19 billion bailout package for farmers. And within that bill was, I think, $16 billion of direct payments to farmers and $3 billion in purchases. So ultimately, we heard, I believe it was Friday or over the weekend, that those $3 billion in purchases are going to happen. I really wasn't sure because we know the way the markets can respond to old news. They act like it's new news, but this is almost a month old. It's 3 weeks old. So this is the $19 billion package, and this was that aforementioned $3 billion that would go into purchases. So having mentioned it again, and it was supposed to happen, it's going to happen in July, clearly having mentioned it again was a way to sort of bring this particular fact back into the spotlight. But I wasn't sure if the market would really gain traction to the upside on it. And luckily traders say, wait a minute, we've already discounted this once. We knew this, and we've already responded. We're already expecting it. And that, I believe, was the 17th, somewhere in that window. So I don't know if we're going to see movement higher, but we saw enough to hit our 855 entry. So we are short the soybean market. And those are the targets I'm looking at. A lot of you are in the LE live cattle futures. Look, if I were, I mentioned the things I think I could have done better, some of the things that that I believe were supply versus demand narratives. And again, on the day that this $3 billion package, which does include purchasing beef, is announced, cattle's coming down. I think cattle overdid it on the move higher. People say there's demand for beef. I know in a lot of grocery stores there's a limit on how much beef you can buy. So clearly there's a demand, but I don't see that plants reopening as necessarily a bullish cattle play, because that's actually a supply narrative. So I know there's a lot of folks that are much more, we have folks who are farmers amongst our members. I have friends that are ranchers and farmers, and everyone's got a different take on what's happening, but I still believe that this market heads lower. Ultimately, it got a heck of a shot in the arm here. But I will say, once we close the gap, which would be down in this area, for those who say, Rog, the meat story, meats, hogs, cattle, way too volatile right now. If we can get out with a small profit or break even, probably not a bad play. So I'm kind of leaving open the idea of trading down to about 89.70 as a kind of an escape hatch, if you will. If you want to get out at 89.70, kind of be my guest. If you just kind of want to get out at that level, you can even treat it as a target. Okay, just kind of say, hey, this narrative got away from me. Who knows when will start to move to the upside again on the perception of demand or whatever. And then we can just treat this market now as an overbought, oversold situation. So then moving on over to, so we covered copper, gold, bonds, beans, cattle. And so those are really the main daily time frames we're in. I mentioned that the Canadian dollar, the 6C futures, look very interesting to me for shorts. Probably one of my favorite ways to buy dollars right now. Buy dollars, short Canadian dollars at the top of the wave. Shorts, we'll probably have a setup here pretty soon. And the other one is the peso. The peso's in probably one of the better downtrends against the dollar. And again, I'd like to see this move into the middle of the wave, to the top of the wave. And I'm open to a short here on the peso. And that opens the door up to an EWW short, which is the country ETF, and possibly another EWC short. Now, I don't like the EWC because EWC is starting to look bullish like a lot of equities markets are. I'll keep an eye on this for maybe if it stops plotting the propulsion dots, that'll make a lot of sense. But EWW and the peso, add it, 6C, add it to our watch list. And I'll see you in the next update.